Okay, so let's continue from where we left. Let's continue from where we left. Last time we were doing a topic of internal reconstruction. We completed that topic. So today we want to discuss another way of reconstructing a company, and that's what we were calling external reconstruction. I introduced this area last time. I introduced it last time, but we did not look at, we were introducing it, or I introduced it when we were looking at the general way of reconstructing a company. And we said there are two ways of reconstructing a company, and one way was the internal reconstruction, which we have so far finished. And now we want to look at another way of reconstructing a company, and that's what we call external reconstruction. Just to remind you, when I was introducing what we said, this is what we said. That let us assume company A is the one being reconstructed. And now we want to reconstruct it through external reconstruction. We said this. For company A to reconstruct through external reconstruction, that company must sell their business to another company. Let's call it company B. So company A, which is being reconstructed, will now have to sell their business to another company. That company B could be another existing company, or it could be a newly formed company. Either way, but another company must come in. We are going to be referring to company A as the selling company, while company B, we shall be referring to it as the purchasing company. Company B is the one buying company A. Now, for company A to sell their business to company B, company A must liquidate themselves. Company A must be liquidated. In other words, so company A must liquidate themselves so that they now can sell their business to company B. Now, in the process of you, company A, liquidating yourself, you, company A, you must close your books. So company A normally has to close their books of accounts. Company B, which is purchasing A, B now will have to open their books. So in this topic, the examiner will normally ask you to show the accounting entries in the books of the selling company. In other words, how they liquidate themselves or how they close their books. The examiner will also ask you to show the accounting entries in the books of the purchasing company, which we are referring to as company B, So let me go through some of the items. But I've said, listen, company A must be liquidated so that they sell their business to company B. When we say company A must be liquidated, we are meaning that company A, all the stakeholders of company A, by the end of the day, they must be paid. We are liquidating company A. So the stakeholders, who include the ordinary shareholders, the preference shareholders, the debenture holders, they must be paid what is due to them. That is company A. They must pay their stakeholders by the end of the day so that they can now sell their business to company B. So in actual sense, company A must liquidate themselves. To liquidate themselves, they are supposed to pay the stakeholders what is due to them. So we want to see what is that process that they have to follow. So allow me now to go through what we are now referring to as the entries in the books of the selling company. Entries in the books of the selling company. Now, what are the accounting entries in the books of the selling company? You, company A, you must close your books so that you can now sell your business to company B. So how do you close your books? So let me go through the accounting entries in the books of the selling company. Number one, company A. You as company A, you may have some assets of yours which B told you that they are going to take over from you. Maybe your motor vehicle, your furniture, your lab, maybe your money in the bank, or maybe stocks and data, whichever it is. So number one entry is you close all assets taken over. Close all assets taken over at their book values. At their book values, you close them to an account we shall be calling realization account. To an account we shall be calling realization account. Let me open it down here. We shall be opening an account called realization account. So I've told you, close all assets taken over at their book values to this account called realization. We know assets are always a debit balance. So for you, company A, to close them, you must credit the assets and you debit realization. So that's step number one. Close all assets taken over at their book values to the realization account. That's number one. You credit the assets and you debit realization. That's number one. Number two, and the key point there is at their book values. That's the key word. Now listen, number two, you as company A again, it could be that you gave out part of your liabilities to company B. B told you they will take over your debentures, or they will take over your creditors, or they will take over your bank overdraft, whichever liabilities that they are deciding they are going to take over. So in other words, you as company A, you close all the liabilities that were taken over again to the account we are calling realization account. So we are saying with the liabilities taken over, with the liabilities taken over, you will debit liabilities. Don't forget, liabilities are always a credit balance. Liabilities are always a credit balance, and therefore to close them, you will have to debit that liability and you credit realization account. Don't write, I'll give you the notes. Don't write, I'll dictate the notes later. But now we are saying number two, with the liabilities taken over, you debit liabilities, you credit realization. Whichever the liabilities, could be creditors, could be bank overdraft, could be debentures, and so on, whichever it is. Number two, that's number two. Number three, you as company A, you are selling your business to company B. You as company A, you are selling your business to company B. It must be that there is something that you as company A, you are charging company B. What is it that you are charging company B to buy you? What is it that you are charging company B to buy you? Whatever you are charging them to buy you, that is what we shall be referring to as the purchase consideration. So number three entry says, with the purchase consideration, with the purchase consideration, how much are you charging company B? Listen, I am not saying how much company B is paying you for now. No, how much are you charging them? Meaning they will pay you later, but for now you are charging them how much? For purpose of illustration, let me assume that I am charging them something like 50 million. So in other words now, I create in my books, me as company A, I create a data in the name of B Limited. So with the purchase consideration, we normally debit the purchasing company, whichever it is, which in our illustration, we are using it as B Limited. You debit the purchasing company and you credit realization. I am assuming it's 50 million. You debit the purchasing company, you credit realization, and you say here B Limited, 50 million. That's our entry number 3, which says with the purchase consideration, you debit the purchasing company and you credit realization. Good. That's number 3. Number 4. We have said that you, company A, you must liquidate yourself, which automatically means that in the process of liquidating your company, you may incur what we call liquidation expenses. So, number 4 says, with liquidation expenses, whatever they are, if you as company A, you are the one who paid it, that liquidation expense, if you are the one who paid it on your own, then you will debit realization, and credit bank with whatever is the liquidation expense. Again, we are saying you debit realization and you credit bank, whatever is the amount of the liquidation expense. Liquidation expenses, whatever it is. Now, listen. It may happen that yes, you, company A, you want to sell your business to company B. It's true, we have said you should liquidate yourself first before you sell your business to B. I have said, in the process of liquidating your company, you may be required to incur some liquidation expenses, maybe 2 million or whatever it is, to liquidate yourself. Listen to this now. Suppose you as company A, you did not have the money to liquidate yourself, but company B wants to buy you, but you don't have money to liquidate yourself. So B decided that they are going to give you that 2 million so that you liquidate yourself, In other words, you are not the one paying, but don't forget, it is your cost. You are supposed to liquidate yourself. So in other words, you as company A, you have incurred that expense, but you have not paid. You will pay it when you receive the money from company B, because B wants to buy you, but you told them you don't have money to liquidate them yourself, so they will give you that 2 million. So in other words, you as company A, you have incurred that expense but not paid. If you have incurred that liquidation expense but not paid, you will still debit realization and credit an account we shall be calling provision for liquidation expense. Provision for liquidation. In other words, create a liability of that 2 million so that once you receive the money, you will pay that liability by debiting that liability and crediting bank. So that's our entry number 4, which says with liquidation expenses, if paid, debit realization, credit bank. If incurred but not paid, you will still debit realization and credit the account we are calling provision for liquidation expenses. That's our entry number 4. Number 5. For number 5, I want to take you back to number 1. Number 1, I told you, close all assets taken over. Close all assets taken over. It may happen that you as company A, B did not want to take over your motor vehicle, or they did not want to take over your furniture. So they never took over your motor vehicle. And I have told you, as company A, we are liquidating ourselves. And when you are liquidating yourself, you cannot leave some accounts pending. No, we must close all the accounts. So what will happen to that kind of an asset where it was not taken over by company B? So you, company A, you may decide you will sell it on your own. Get our own buyer to buy it. So number 5, we are saying, with assets not taken over, with assets not taken over, but sold by the selling company. With assets not taken over by the purchasing company, but sold by the selling company, you as A Limited, you are the one selling. So in that case, you are the one receiving the money. You will debit bank and you will credit the asset. Let us assume that the asset is a motor vehicle. So you will debit the asset, debit bank. Let us assume the motor vehicle had a book value of 2 million. You sold it for 1.5 million. So you will debit bank, and obvious, you credit motor vehicle by 1.5. Again, you can't leave the account pending. You have just sold the motor vehicle, which had a book value of 2 million. You have sold it for 1.5 million. You have made a loss on disposal. That loss on disposal, you will transfer it to the realization account. Listen, remember, we are not running a normal business. So if it was a normal business, obvious, I would have taken the loss to the profit and loss. But now we are reconstructing this business. And therefore, you take the gain, or whichever it could be a gain, it could be a loss, you take it to your operating account. You take it to your operating account. And your operating account in this case is the realization account, So for this illustration, I have a loss of 500. I take it to the realization account. I credit motor vehicle, I debit realization. Assuming you sold it for 2.5 when the book value was 2 million, you sold it for 2.5, meaning you sold it at a gain of 500. Again, you would debit the motor vehicle and credit realization. So that's our entry number 5, which says, with any assets not taken over by the purchasing company, but sold by the selling company, you debit bank, you credit the asset. And with the balance in the asset account being either gain or loss on disposal, we are saying you transfer it to where? To the realization account. That's our entry number 5. Number 6. Again, for number 6, I want to take you back to number 2. Number 2, we said with liabilities taken over. With the liabilities taken over by the purchasing company, we said you debit the liabilities. You remember, I told you credit realization. But what if company B decided they are not going to take over your creditors? Maybe they only took over your debentures, they took over your bank loan, but they decided they are not going to take over your creditors. And we have agreed you must close all the accounts. You cannot leave some accounts pending. You are liquidating yourself. What do? So you as company A, you may have decided, or you may decide to pay such a liability on your own. So our entry number 6 says, with liabilities not taken over, with liabilities not taken over by the purchasing company, but paid by the selling company. You paid that liability on your own. Good. What should be the double entry? Let's use creditors as an example. We assume the creditors have a value of 2 million. And maybe the question tells you the creditors were willing to accept 1.8 million in full settlement of the debt. Question tells you the creditors were willing to accept 1.8 million in full settlement of this debt. So you paid them 1.8. So you must have debited creditors, you must have credited bank by 1.8. So we are saying our entry number 6, with any liabilities not taken over by the purchasing company but paid by the selling company, you debit liability, you credit bank. But from this question, we have received a discount of 200 from our creditors. We owed them 2 million. They were willing to accept 1.8 million in full settlement, and therefore, as a company, we have received a discount. If it was a normal business, I would take it to the P&L account. That is discount received. But I've told you, we are not running a normal business. We are reconstructing this business. We are reconstructing this business. And therefore, whatever gain you make or whatever loss you make, take it to the realization account. So we are going to debit creditors by 200 and you credit realization account. If there is any discount that we are receiving from creditors, if there is any discount that we are receiving from creditors, that is what you do. You debit creditors and you credit realization. Good. That's our entry number 6. Now, before we go to number 7, 8, 9, 10, because there are about 15 entries. There are about 15 entries in the books of the selling company. Let's put them down now. Let's put down the accounting entries. So have another subtopic. Remember, we had finished the topic of external, internal. Now we are putting down. We had finished, I think, yes. Yeah, you can see last time. Yeah, I think we finished even the question we were doing last time. Let me see. Yeah, we had finished that question. Yeah, we had even prepared the statement of financial position, meaning we had finished that question. Good. Now we can write a subheading, external reconstruction. So put down that subheading, external reconstruction. External reconstruction. Then you say this. Under that, this occurs where a company is liquidated. This occurs where a company is liquidated, where a company is liquidated, where a company is liquidated and sells its business, to a newly formed company, you can put it that way, to a newly formed company or to another existing company. So we have said this occurs where a company is liquidated and sells its business to another, or to a newly formed company, or to another existing 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 company. Good. Then have another subheading under that, entries in the books of the purchasing company. Entries in the books of the purchasing company. Entries in the books of the purchasing company. Entries in the books, not in the purchasing, in the books of the selling. Entries in the books of the selling company, Entries in the books of the selling company. As a subheading, entries in the books of the selling company. Entries in the books of the selling company. Then let us put them down. Number one, put it this way. Close all assets taken over. Number one, close all assets taken over at their book values. Close all assets taken over at their book values to the realization account. Close all assets taken over. Close all assets taken over at their book values to the realization account. So put it down. That is debit. Now you are putting the entry. Debit realization. Credit assets. Debit realization. Credit assets. Debit realization. Credit assets. That's number one. Number two, if you're through, number two, with liabilities taken over. With the liabilities taken over by the purchasing company. With the liabilities taken over by the purchasing company. Number two, with the liabilities taken over by the purchasing company. Debit. Liabilities. Debit liabilities, credit realization. Debit liabilities, credit realization. Debit liabilities, credit realization. That's number two. Number three. With the purchase consideration. With the purchase consideration. With the purchase consideration. Debit. Purchasing company. Debit purchasing company. Maybe you can put in bracket data just to remind you. I told you they are not paying. You are charging them. So maybe you can just put in bracket data to remind you that at this point in time, I am only creating a data by the name of B Limited, whatever the amount. So we debit the purchasing company, you credit realization. When we shall receive from them, we shall credit. But now we are charging them just like you normally charge any data. Good. So that's our entry number three that says, with the purchase consideration, you debit the purchasing company, credit realization. Debit purchasing company, credit realization. That's number three. Number four, with liquidation expenses, paid for or incurred. With liquidation expenses paid for or incurred. With liquidation expenses paid for or incurred. Debit realization. You debit realization. Credit bank. Stroke provision for liquidation. Provision for liquidation expenses. You are debiting realization, you credit bank, or you credit provision for liquidation expenses. That's our entry number four. That's our entry number four. So we want to go to number five. We want to go to number five now. We want to go to number five, which we have already talked about. And number five. Number five, with any assets not taken over. With any assets not taken over by the purchasing company. with any assets not taken over by the purchasing company, but sold by the selling company, with any assets not taken over by the purchasing company, but sold by the selling company. Debit, bank, credit, asset. Debit, bank, credit, asset. With any assets not taken over by the purchasing company, but sold by the selling company. With any assets not taken over by the purchasing company, but sold by the selling company. Debit, bank, credit, asset. Then below that, andika NB. NB below that. NB below that. Then you say this. With the balance in the asset account. With the balance in the asset account. With the balance in the asset account. Being either with the balance in the asset account. Being either a gain or loss on disposal, with the balance in the asset account being either gain or loss on disposal, comma, transferred to the realization account, with the balance in the asset account being either a gain or loss on disposal, comma, transferred to the realization account, transferred to the realization account. That's number 5. That's number 5. Let's go to number 6. Number 6. Number 6. With liabilities not taken over. Number 6, with the liabilities not taken over by the purchasing company, with liabilities not taken over by the purchasing company, but paid by the selling company, with liabilities not taken over by the purchasing company, but paid by the selling company, but paid by the selling company. Debit, liabilities, debit, liabilities, credit, bank. Debit, liabilities, credit, bank. Debit, liabilities, credit, bank. Below that, andika NB. Below that, andika NB. Below that, NB. With any discount received from creditors, with any discount received from creditors, with any discount received from creditors, debit, creditors, credit, realization. With any discount received from creditors, debit, debit, creditors, credit, realization. Debit, creditors, credit, realization. Good. That is our entry number 6. So let me go back to the other entries now. Let me go back to the other entries now. We had reached number 6. Now we want to go to number 7. We said there are 15 entries in the books of the selling company. And that's what I want to continue now. There are about 15. So far we have talked about 6. Let me now go to number 7. So let me talk about it first. Now, I told you this. Listen, that we are selling company A. Company A is selling their business to company B. I told you company A must liquidate themselves so that they pay their shareholders or stakeholders everything that is due to them. Because we cannot liquidate ourselves and leave some accounts pending. No. And two, the stakeholders must be paid. Now listen. That's what I want to talk about, number 7. There are many group of stakeholders that may be found in a company. One of them could be ordinary shareholders, preference shareholders, and others. Those guys must be paid. Listen. But let's take ordinary shareholders, for example. There are many things that you as a company, you owe to your shareholders. One thing you owe to them is their share capital. You also owe them their reserves. Whatever reserves are found in the company, they belong to shareholders. And many other things. Listen. And therefore, when we are liquidating this company, we cannot pay the ordinary shareholders what we owe to them through an account called ordinary share capital. It's true, we owe them their share capital, but we don't pay them through that account. Then we also don't pay them their reserves through a reserve account. No. What do you do when you are reconstructing this company? Listen. So what you do is that you open one account and put everything that you owe to the ordinary shareholders in that account. So that when you are paying them finally, at the time you will be paying them, you will pay them a lump sum for everything that you owe to them. Instead of paying them in piecemeal, that means you pay them what you owe to them through ordinary, you pay them what you owe through them share premium, maybe general reserve, maybe revaluation reserve, and so on. No. We are saying consolidate everything that you owe to the ordinary shareholders into one account. In other words, create a liability account for everything that you owe to the ordinary shareholders. Same will be done to preference shareholders. That you can't pay the preference shareholders again what you owe to them through their preference share capital. No. Because there are many things that you owe to them. One, you owe to them their preference share capital. You owe to them preference dividends in arrears. If they are there, you have to pay them. So we are now saying, we are coming to a point now where from number 7 now, we want to create liability accounts for all our stakeholders. So that when it comes to time of payment, we only pay them once. I hope you're getting that. For ordinary, for example, you owe them their share capital, you owe them their share premium, you owe them their whatever. You owe them anything that you owe to them. So step number 7 says, now I'm taking it. Step number 7 says, you transfer the balance of the ordinary share capital. You transfer the balance of the ordinary share capital to an account we shall be calling, ordinary shareholders members account. You owe them their share capital. Take it to a liability account that we want to create, which is called ordinary shareholders members. Ordinary shareholders members account. Some books will call it ordinary shareholders sundries members account. It's okay. But we are saying this is now an account that represents what you as a company A, you owe to your ordinary shareholders. Anything that belongs to them will come to this account. One thing that belongs to them is the amount of the share capital, ordinary share capital. So step number 7, we are saying transfer the balance of the ordinary share capital to this account. We know share capital is always a credit balance. So to close it, you debit share capital, you credit this account. So you come and say your ordinary share capital. Whatever it is, that's our entry number 7. That says transfer the balance of the ordinary share capital to the ordinary shareholders members account. Good. That's number 7. By debiting ordinary share capital and crediting ordinary shareholders members account. Number 8, apart from their share capital, you owe them the reserves. All reserves that are in the company, they belong to shareholders. So step number 8 says you transfer reserves to, again, the ordinary shareholders members account. They own those reserves. Now listen, if it is a positive reserve, like maybe share premium, general reserve, revaluation reserve, we know such balances which are positive reserves are a credit balance. So to close them, you debit that reserve. Let us assume it's share premium. You will debit share premium and you will credit ordinary shareholders members account. You come and say a share premium. It could be general reserve. It could be revaluation. It all belongs to shareholders. Good. So that is number 8. Transfer reserves to the ordinary shareholders members. Now listen. There are other reserves that may be negative reserves. For example, all the accumulated losses that your company has made, whatever the retained losses, those are also reserves. Retained losses is a reserve, but it's only that it's a negative reserve. It still belongs to the ordinary shareholders. So give them their reserves. Let them take over the loss. We know retained losses is always a debit balance. If you go to the P&L account of that company, you will find a debit balance representing a retained loss. So to close that retained loss, you credit P&L account and you debit the members. You come and see your P&L account, whatever it is. So I have said it does not matter whether it's a positive reserve or a negative reserve. If it's a positive reserve like share premium, you debit share premium, you credit the ordinary shareholders members account. If it's a negative reserve like the retained losses, we are saying you debit ordinary shareholders members and you credit profit and loss. Good. That's all for step number 8. Let me go to number 9. For number 9, I want to take you back to number 1 and number 5. For entry number 9, I want to take you back to number 1 and number 5. Number 1, I told you, close all assets taken over. That's what we said. Number 5, with any assets not taken over but sold. Now, listen to this now. You as company A, suppose you have an asset which company B did not want to take it over under number 1. 2, you could get somebody to sell to under number 5. Yet, we are liquidating our company. So what happens to such assets which could not be taken over by B and you couldn't get somebody to sell them to? You as company A. Yet we are liquidating ourselves. Listen. Who then takes over the loss of such assets? Who takes over? Because we must liquidate this company and we must close all the books. So if there is an asset that can't be taken over from us by B, we couldn't get somebody to sell it to. That kind of an asset, somebody within our company must take the loss of such an asset. And who are the people to take over? Obvious, it's the owners of the company. And the owners of the company are the ordinary shareholders. Now listen, we refer to such kind of assets as fictitious assets. Assets that could not be taken over by B You couldn't sell them. We normally refer to them as fictitious assets. For example, you could have assets in your books as copyrights. B decided they don't want to take up your copyrights or trademarks or even goodwill. Those are kind of assets that company B may not want to take over. And especially, we are saying they are normally in form of intangible assets. Copyright, trademark, patent, goodwill. Those are kind of assets that company B may not have taken them over, and you, A, you couldn't have sold them to anybody. Who takes over the loss? It is the owners of the company, and the owners of the company are the ordinary shareholders. Good. So that is our number 9, which says you transfer fictitious assets now. With those fictitious assets, you give them to the owners of the company. How? We have said, and we know, assets are always a debit balance. So to close that asset, you credit the asset and you debit the ordinary shareholders' members' account. So you come and debit here to say your fictitious assets, whatever it is. Okay, that's our entry number 9, which says with any fictitious assets, transfer fictitious assets to the ordinary shareholders' members by crediting the fictitious assets, and you debit ordinary shareholders' members, whichever the asset. That's our entry number 9. Good. We go to number 10. Number 10. Listen. I hope you have realized that step number 7, 8, and 9, step number 7, 8, and 9, they are all related. Step 7, 8, and 9, they are all related in the sense that these are things that belong to ordinary shareholders. Ordinary shareholders. That's what we have said. Now, but I also told you, in a company, you may have more than one group of stakeholders. Suppose we had preference shareholders also. I told you, you can't pay them their share capital through their share capital account. No. You can't pay them their dividends, which are still in arrears, through that preference dividends account. No. So the way you have done everything for ordinary, do the same for preference. So we are saying step number 10 is that you transfer again. Transfer the balance of preference share capital to a liability for them also. The way you created a liability for ordinary, you also create a liability for them. What's the name of that liability? We shall be calling it preference shareholders members. Preference shareholders members account. Preference shareholders members account. To close that preference share capital, you debit preference share capital, you credit preference shareholders members. That's what we are assuming, whatever the amount. That's our step number 10 that says transfer the balance of the preference share capital to the preference shareholders members account. Listen. Then still under number 10, if you realize from the question that these preference shareholders were not paid their dividends, in other words, the company still has dividends in arrears, what do? It belongs to them. So with any preference dividends in arrears, listen, you know, and we have said this before, even when we were doing internal reconstruction, listen, that preference dividends in arrears don't appear in the books. I told you that. And you remember we were giving an example of a contingent liability as preference dividends in arrears when we were reconstructing the company through internal reconstruction. Listen, and we said when we were reconstructing the company through internal reconstruction, that with any contingent liability that arises, we said you must crystallize it. In other words, make it a liability. So you remember when we were doing internal reconstruction, to crystallize any preference dividends that were still in arrears, we had to debit what? Capital reduction, I hope you remember, and we had to credit that contingent liability, whichever it is that the question will give you. In our question or in our illustration, we are assuming it's preference dividends that are still in arrears. I told you the key important point is that contingent liabilities don't appear in the balance sheet. And when you are reconstructing the company, they must be crystallized. So we looked at how to crystallize them when we were dealing with the topic of internal reconstruction. Now we are dealing with the topic of external reconstruction, where at the same time again, we as Company A, we owe the preference shareholders dividends for the last 3 years. If you go to the balance sheet or to the books of Company A, will you find that liability called preference dividends in arrears? No, it doesn't appear in the books. Now that we are reconstructing, it must be crystallized. In other words, make it a liability. Good. So how? For external reconstruction, we owe the preference shareholders that amount. We have already opened an account for them to represent anything that we owe to them, which is this account, preference shareholders members account. Good. So we are saying with any preference dividends in arrears, we shall be debiting realization. We shall be debiting the account called realization, and we shall be crediting with any preference dividends in arrears. We shall be debiting realization, and we shall be crediting preference shareholders members account. That's what we shall be doing to make it a liability and to increase what we owe to them. That's what we are saying. That's our entry number 10, which says transfer the balance of the preference share capital to the preference shareholders members. We have debited preference share capital. We have credited preference shareholders members. Then I've gone further and said with any dividend, a preference dividends in arrears, I have said you debit realization and you credit preference shareholders members. Good. Before we go to number 11, 12, 13, and 14, and 15, let's put down the next few that we have mentioned. So let's go back. We were at the point of number 6. Now we can put down number 7. Let's go with continue with the notes now. Let's continue with the notes now. Let's continue with the notes. Number 7. Number 7. Semi-V. Transfer the balance. Number 7. Transfer the balance. Transfer the balance. Transfer the balance of the ordinary share capital. Transfer the balance of the ordinary share capital to transfer the balance of the ordinary share capital to the ordinary shareholders members account. Transfer the balance of the ordinary share capital to the ordinary shareholders members account. So number 7, you debit ordinary share capital. You debit ordinary share capital and you credit ordinary shareholders members account. Ordinary shareholders members account. You debit before we proceed, let me just highlight something because I know we have new students. Today is a free lesson. Let me explain something there. Today was a free lesson, so there could be some new visitors. Listen to this, especially for the new visitors. Sometimes you may be disconnected because of your Wi-Fi strength being weak. Listen, especially when you are watching a live video like now. Sometimes your Wi-Fi strength could be weak and you are disconnected. Listen, to come back to class, what do? We have two ways you can try to use. Number one, you can retry and refresh the page. On the top left or top right corner of your page where you're watching the video, there is always a refresh button. You can click that refresh button to refresh your page. But do not click, listen, do not click on the disconnected video. That will not take you back to class. But you can refresh your page using the refresh button, either on the top left or on the top right. That will bring you back to class. The second way to come back to class is to go back and click on the link that you received for the class. That's where you can go back and click the link again, which means it's like you're joining the class again. That's what we are trying to say. But the point is, I'm trying to say, don't click on the disconnected videos. No. Refresh your page using the refresh button at the top, or you go click on the link that you received for the class from wherever you received it. Okay? Good. Let's continue. That was just because of the new freshers. Otherwise, I think our students know that when it's a live class, sometimes you are disconnected because of your Wi-Fi strength. You refresh the page. Good. Now let's continue. We are at number 7. Number 8. Number 8. Put it down. Number 8 say this. Transfer reserves to the ordinary shareholders members account. Transfer reserves to the ordinary shareholders members account. Transfer reserves to the ordinary shareholders members account. Below that, andika number A, we have said transfer reserves to the ordinary shareholders members account. Number A, if positive reserve, e.g. share premium, if positive reserve, e.g. share premium, debit, share premium, credit, ordinary shareholders members. Debit, share premium, credit, ordinary shareholders members. Debit, ordinary, we are saying debit, share premium, credit, ordinary shareholders members. That's number A. Number B, if negative reserve, e.g. accumulated losses, if negative reserve, e.g. accumulated losses, debit, ordinary shareholders members, debit, ordinary shareholders members, credit, profit and loss. Debit, ordinary shareholders members, credit, profit and loss account. It's an accumulated loss. I told you losses are always a debit. So to close it, you credit it. Good. That's number 8. That's number 8. Number 9. Number 9. Number 9. Transfer fictitious assets. Transfer fictitious assets. Transfer fictitious assets to the ordinary shareholders members account. Transfer fictitious assets to the ordinary shareholders members account. Debit ordinary shareholders members. Debit ordinary shareholders members. Credit fictitious assets. Fictitious assets. Okay, that's number 9. Let's go to number 10. Number 10. Number 10. Transfer the balance. Number 10. Transfer the balance of the preference share capital. Transfer the balance of the preference share capital to transfer the balance of the preference share capital to the preference shareholders members account. Transfer the balance of the preference share capital to the preference shareholders members account. Debit preference share capital. Debit preference share capital. We are closing it. It's an amount we owe to the preference. Then you take it to the liability, which we are calling preference shareholders members. Preference shareholders members. So we are debiting preference share capital and crediting preference shareholders members account. That's number 10. Still under number 10, andika NB. Still under number 10, NB. Still under number 10, andika NB. With any preference dividends in arrears, with any preference dividends in arrears, with any preference dividends in arrears, debit realization, credit preference shareholders members. Debit realization, credit preference shareholders members. Good. So that's our entry number 10. We want to go back and discuss the remaining first. So finish, I go back. I hope you're through now with the copying. Yes. Okay. Let me take you back to the other style of the entries. We go to number 11 now. Here, Now, number 11, listen. Number 11, I want to take you back to number 3. Number 11, I want to take you back to number 3 entry. What did we say about number 3? We said with the purchase consideration. With the purchase consideration. I told you that time we were creating a data by the name of B Limited. That's what I told you. And so when we were doing number 3, I told you, you will debit the purchasing company and you will credit realization. Here. Where is this B Limited? Here. So we debited this B Limited as a data. That's what I told you. And I told you we shall credit realization. Now listen, a time has come for B Limited to pay us. A time has come for them to pay us. Listen, Company B may decide they are going to pay you that 50 million in various ways. They may decide they are going to pay you part of it in cash, part of it in terms of shares, or maybe part of it in terms of debentures. For purpose of illustration, let us assume that the question tells you that out of this 50 million, 10 million was paid to us in cash. We are receiving. We were also given shares worth 20 million as a payment. And maybe debentures again were 20 million. So now, listen, we are not issuing these shares, we are the ones receiving them. We as Company A, we are receiving them as a payment. So to us, they are obviously assets. So our entry in number 11 says, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If you are receiving cash, you should debit cash and credit the purchasing company. You come and say your cash, 10 million. If you are receiving shares, you debit shares, which I'm assuming 20 million, and you credit the purchasing company. If you are receiving debentures, you are receiving, not issuing, receiving, you will debit debentures by 20 million and you credit the purchasing company by 20 million. So that is our step number 11 that says, with the receipt of the purchase consideration, either in form of cash, shares, or debentures. If it's cash, you debit cash and you credit the purchasing company. We are receiving from our data, like another data, like any other normal data, you credit data whenever you're receiving from them. That's what we are saying. If you are receiving shares, you are not receiving them by you issuing, you are receiving them as an asset. So you debit shares account, of course you will call it shares in B account or B Limited. You debit shares account and you credit the purchasing company. If you are receiving debentures, you will debit an account called debentures in A Limited. No, B Limited, because you are the one A receiving. Debentures in B Limited, 20 million, then you credit the purchasing company. Good. So that is our entry number 10, number 11, which says with the receipt of the purchase consideration. Number 12. Now listen carefully. Number 12. Now that we have cash, now that we have shares, now that we have debentures, we as A, and I told you, whenever a company is liquidated, the stakeholders must be paid. So the question is this. Now I have received cash worth 10 million. I've received shares worth 20 million. I've received debentures worth 20 million. But me, A Limited, I have two categories of stakeholders I owe money to. I owe money to the ordinary shareholders and I owe money to preference shareholders. Who should I pay first? That's the question. Of course, you know, whenever a company is liquidated, the preference shareholders normally rank first. So the point now we are doing in step 12 says, you pay the preference shareholders the amount due to them. Pay the preference shareholders. You had opened a liability for them for everything that you owe to them. Now that you have received money or whatever it is, pay them. So step number 12 says, pay the preference shareholders what is due to them. If you are told to give them cash, go and credit the cash that you received and go debit the member's account. We had opened it here, down here, member's account. You come and debit. You say your cash, whatever it is. If the question tells you that these preference shareholders were given maybe shares, go pick the shares from where you received it. You debited shares account. Go and credit the shares and you debit the members. You come and see your shares. Whatever the question will tell you. If you are giving them debentures, then go pick it. You received it. Go pick it. So you go to where you received it here. You credit it. And you now debit the members. You come and say your debentures. Whatever it is. That's our step number 12. Which says, with amount paid to preference shareholders, with the amount that you are paying to the preference shareholders, debit preference shareholders members, credit either cash or you credit shares or you credit debentures, whichever it is. Good. That's our step number 12. 13. We are now on step 13. Now, for step 13, let me take you to the account called the preference shareholders members. On the credit of this account, we credited this account with what we owe to the preference. One in terms of in terms of preference share capital, and the other one in terms of the arrears of the dividend. On the debit of this account, we have given them the payment, either in form of cash, shares, or debentures. Now listen. Step number 13 says, there will be a balance in this account. In other words, with the balance in the preference shareholders members, that balance could either be a gain or loss on payment. We are paying the preference shareholders what is due to them. Let me assume for purpose of illustration that the credit side, the total there is 2,000 or 2 million. But when you add the items you have debited on this side, you find it's 1,800. The payment side is 1,800. The amount owing is 2 million on the credit side. So there is a difference of 200. We owe the preference shareholders 2 million, but we have paid them only 1.8 million. There is a difference of 200. Obvious. That is a gain to us. We are paying them less than we owe to them as a company. That's a gain. That gain of 200, you will debit the preference shareholders members and you will credit realization. And you credit realization. If it is a gain on payment, whatever it is, you credit realization. What if on this account, the debit side of the preference shareholders members was 2.8, but what I'm owing them on the credit side is 2 million, a difference of 800 on the credit side, meaning I paid them more than I owe to them. That's obvious, a loss. We are paying more than we owe to them. That's a loss to us. Again, transfer to the realization. You would credit the preference shareholders members and you debit realization. That's our step number 13. That's our step number 13 that says, with the balance in the preference shareholders members being either a gain or loss on payment, you transfer it to the realization account. Whether it's a gain or loss, transfer it accordingly. I've talked about when is it a gain. It's when you owe them more, but you're paying them less. That 200. Take it to the realization. If you are paying them more than you owe to them, that's a loss. Take it still to the realization. That's our entry number 13. Number 14. So here I was talking of balance in the preference shareholders members. Number 14. Now listen. We are selling our business, we as company A, to company B. Listen now. You want to know whether you, company A, did you sell your business to B at a gain or loss? Could we have sold our business at a gain or loss? That's our step number 14. So step number 14 says, with the balance in the realization account. Remember, we are selling the business and our operating account is the realization account. So there will be a balance in that account. In this account called realization, there will be a balance. That balance will either be a gain or loss on selling. You can see on the debit side of the realization account, that's what we gave out. We started with the assets taken over. We incurred a liquidation expense. On the credit side, that's what we are receiving. So what happens if the credit side is more than the debit? What does it imply? It implies that you are receiving more than what you are giving out, you as company A. Obvious, if you are receiving more than what you are giving out, then it means you sold your business at a gain. You are receiving more than what you are giving out, you sold your business at a gain. That would be on the debit side. What if the debit side is more than the credit side, meaning you gave out more than what you are receiving? Then automatically you sold your business at a loss. That would be on the credit side. Listen, when you sell your business at a gain or loss, who takes over that gain? Who takes over that loss? It's obvious. It is the owners of the business. And the owners of the business are the ordinary shareholders. Good. So whatever balance is in the realization account, that balance should be transferred to the ordinary shareholders members account. If it's on the debit side, you come and say your ordinary shareholders members. We saw it's a gain, so you go take it to the ordinary shareholders members. Here, you come and bring it here, realization. Or it could be the other way, whichever way. That's our entry number 14, which says, with the balance in the realization account being either a gain or loss on realization. We have said if it's a gain, you will debit realization, you will credit the ordinary shareholders members. Of course, if it's a loss, you will credit realization and you will debit the ordinary shareholders members. Good. That's our entry number 14. Number 15, and the last one. I told you, listen, the last person to be paid are the owners of the company, and those are the ordinary shareholders. So now they have even taken over the loss of selling the business. Who? These ordinary shareholders. So finally we must pay them. So pay ordinary shareholders what is due to them. We pay the ordinary shareholders what is due to them. The question will tell you, don't forget, we received cash, we received shares, we received debentures. The question will tell you, what is it that you are giving to them? If you are giving them the cash that we received, go credit that cash from wherever you debited, and you debit the members' account, the ordinary shareholders members. You come and see your cash. If the question tells you they were to be paid in terms of shares, go pick it from where you received it. We debited shares. Where is it? Here. Now go credit. You will credit the shares because it's an asset you are taking, and you are debiting the members. Come and see your shares. If the question tells you are giving them the debentures, you received it. Go pick it from where you received it. Here it is. Go pick it, you credit it, and you debit the members. That's all. Once you do that, you have liquidated your company because they're the last people to be paid. And that way, you have liquidated your company. Good. So, we had written the notes up to number what? Up to number 10. Listen, up to number 10. Now, because of these new students, I want to pass some information. So that before we finish the writing of the notes, let me pass that information first to the new students. Now, to the new students, listen. If you wish to continue with us for the normal class, for advanced financial reporting, this is for the new students now who are attending this for the first time. If you wish to start classes or continue with us, our advanced financial reporting, we have two classes. We have early morning classes and we have evening classes. Our early morning starts from 5:30 a.m. to 7 a.m. every Monday, Wednesday, and Friday. That's the timing for early morning classes. Our evening classes starts from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday, like today. Those are the timings for evening classes. Okay? We are charging 4,000 shillings. We are charging 4,000 shillings for the semester. Of course, we accept payments in installments. We accept payments in installments. If you are interested in any of those two classes, then you can call me on this number 0722 65 8875. Okay? That's how you can reach me. Either you text or you call that number 0722 65 8875. Okay? Now, those who have attempted this subject before and they would wish to do what we call special revision, we also have special revision class. That's where we start. We do only revision of the questions. Do questions and answers. Do questions and answers. For those who have attempted this paper before and they feel they don't want to go back to the normal class, but they want to do revision, then you can still get our special revision class. For the timings, you call me. I have forgotten the timings. I can check the timetable, but we have special revision classes for advanced financial reporting. Good. Now listen. Again, you are here doing advanced financial reporting, but you may have a friend who is doing financial reporting. We also offer online classes for financial reporting of the intermediate level, and for that, again, is from 8 p.m. to 10 p.m. every Tuesday, Thursday, and Friday for financial reporting of the intermediate. That's what used to be called Section 3. So if you have a friend who wants to join that class, again, now listen. Whether for advanced financial reporting or for financial reporting, listen everybody now. Our system is such a way that even if you miss a class, let's assume you are an FR student and on a Friday you miss a class. Does it mean that class is gone? No. You can still go back and watch the class that you missed as many times as you want. Okay? Our system is such a way that even if you miss a class, you can still get the video of the class. You just go to the group where the link was posted and you will be able to click on the link and you will be able to watch the class at your own free time. It could be also not even missing. It could be that I have taught you and you want to refresh your mind on that class. Just go back to the group where the link was posted and you click on the link of the class you want to listen again, and you will be able to listen to it at any time, as many times as you want. Okay? Now, again, listen. For some of you, you have freshers who are beginning accounting course. So I'm also offering financial accounting for the foundation level and the one of ATD level, and also of the one of CS and CIFA. They have accounting papers there also for beginners. So if you have somebody who is joining the accounting as a profession and is a beginner in the foundation level of CPA or for the ATD level or CS level or CIFA, then you can recommend them to attend our classes. Good. Now, for everyone, I appeal to you to go and subscribe to my YouTube channel. Go and subscribe to my YouTube channel. Which is called CPA Joseph Njuguna. Subscribe to that channel so that you can get notifications whenever I post new videos to the public. Whenever I want to post videos to the public through YouTube, you will be notified. I think I've said everything to the new students now. I have talked about those who want to continue with us, and maybe they are listening to me, and you want to continue with the advanced financial reporting. It's either early morning or evening. I've given you the timings for the early morning and the times for the evening. We have said I am charging 4,000 shillings. You can reach me through this number 0722 658875. That's what we have said. I've also said for your friends who are doing financial reporting of the intermediate level. That's what used to be called Section 3. Tell them that we have classes every Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. Then also your friends who are doing financial accounting, either of the foundation level, ATD, CS, and CFA, we are also offering that financial accounting. Finally, I appeal to you to subscribe to my YouTube channel, which is called Joseph Njuguna, CPA Joseph Njuguna, so that you may be notified whenever I post new videos to the site. Otherwise, for my normal students, listen, we can stop there now. I'm talking to my normal students who have joined. We can stop there. We shall continue from there next time, where we shall now finish the writing of the notes of the books of the selling company. I've discussed all of them. It's only that we have not finished writing the notes, but we have discussed them. Then after we have put down the notes on the books of the selling company, I will do the books of the purchasing company. The books of the purchasing company, they are not many. They are normally about 6 of them. Once we do them, then we shall now do a past paper question. Now we shall do a past paper question. Good. So maybe for now we can stop there. I don't know whether we had any fresher in our group who wants to comment something. You can say something. And by the way, we have not chatted today. I've not asked you a question. Somebody to chat and say hi. I've not asked you. For the normal students, today I've not asked you a question. You can chat and say hi or bye, whatever you want to say. We have not chatted today because I didn't ask you a question. There was nothing to calculate today. So you say hi, you chat and say hi, so that I know we were discussing something. Yes, you chat and say hi. Okay. Good. Thank you. Thank you, Janet. Is it Lynette? Okay, good. Thank you. See you next time. So we shall finish the topic next time. Okay. Bye. Good night. Felix, good night. Okay. Bye.